Many thanks for staying with us. The Director General of the Manufacturers Association of Nigeria, Segun Ajayi-Kadir, has stated that the recent 150 basis points increase in monetary policy rates by the Central Bank of Nigeria will further compound the already high cost of doing business in the country. According to him, tightening and increasing loan costs would raise production expenses, limit fund accessibility, and reduce investments and competitiveness in the manufacturing sector. Ajayi-Kadir noted that recent decisions by the Monetary Policy Committee would further worsen the sector's challenges. He indicated that the monetary stance would constrain investment and expansion, hindering manufacturers' ability to invest in innovative technologies, expand production capacities, or explore new markets. And now to discuss this further, we are joined by Kenneth Ikenwa, a business and social policy analyst. Thank you so much, Mr. Kenneth, for joining us.
Good evening, Lekon. Nice being with you this evening.
Of course, it's nice to have you around too. Now, we see the CBN governor, of course, he has said that the increase in the benchmark rate was necessary to tame inflation and ensure price stability. But then would you blame the MPC under his watch for hiking the rates?
The question here would not be a question of actually trading blames or apportioning blames. Theoretically, this is the ideal thing to do, ceteris paribus, which means if all things were actually equal. But we have to come to terms with the kind of economy that Nigeria actually is characteristic of. Now, the economy is swinging in the direction of very high regulation. And as much as the regulations and policies are very, very high, it's also an economy that is dealing with the complexity that results from high degrees of leakages and very low degrees of compliance. So I think that at this point in time, one of the things that the CBN should be working on and other institutions is actually looking at these institutional voids, this market voids and these infrastructure voids that actually enable zero compliance and also enable leakages in the system. Because if you have a good intention and the outcomes are usually bad, then you must go back to the drawing board and actually find out what is wrong. And I think what is actually wrong in this case is that we're designing policies that are not factoring in how best we can strategically manage the leakages in the system and the zero compliance in the system.
So when you say, so Kenneth, when you say leakages, would you say leakages on the monetary side of things, on the fiscal side of things? Because we need to have an understanding of that. Where are the leakages?
The leakages are leakages that are compacted by the kind of culture that we have in our country. It is a culture that in one way or the other, I wouldn't want to say that, I mean, on global TV about my country, but we must come to terms with the fact and call a spade a spade. We know that when these policies are made, there are certain other factors, human and non-human, kinetic and non-kinetic, that kind of like facilitate corruption in the system and that makes the regulators look like toothless bulldogs. So these leakages have to be dealt with. You take a look, for instance, at the foreign exchange regime and the foreign exchange market. The policies are sometimes fantastic, but yet again, you find out that people find their way to get these monies from the approved institutions and get it, round tripping in banking back into the black market. So how do you account for such anomalies? So when we are able to deal with these leakages in every facet of our lives, in every facet of our social structure and milieu, then we can be talking of proper organization for development and economic growth. So that is actually what I mean. And so those in the CBN actually know what I'm talking about.
So is that how other countries have actually dealt with the issue of inflation within their own climes? Because we've seen monetary tightening measures in other countries and they have worked. For instance, we can mention Argentina. Now the economy is recording gradual, appreciable growth. So if you are to be very critical about this, aside of leakages, what other areas do you think we should be looking at when it comes to policy implementation?
Well, I think the first thing we have come to terms with is that we do not compare apples with oranges. All right, comparing a country like Argentina and Nigeria, I mean, is a no-go area. It's like comparing apples with pineapples, and that will not fly. Now, the culture and the context and the policies are different. But the problem I think we also have, or the challenge I think we also have, is that we import policies, import textbook policies, import policies that are imposed on us by some institutions outside Nigeria, and forget that the context and the culture and the contradictions that characterize our society are quite different. So if these things have worked in Argentina, we must come back to the 3 C's. What's our own context? What's our own culture? What are the contradictions that are peculiar and particular to the Nigerian society and system? All right. For instance, in Argentina, it's almost a country that has a mono language. You are looking at a country, Nigeria, that has over 350 different ethnic groupings and cleavages, and you expect that we're all going to sync together in terms of policy. So we must be organic and look at policies that actually deal with the peculiarities and particularities of our own social system, our culture, and our structure. And that way we can actually forge a way forward and work in the path of economic growth, progress, and prosperity, as it were, for all.
Okay, so Kenneth, as it now affects the manufacturing industry in the areas of production costs, fund inaccessibility, lack of support and all that, if manufacturers continue to pass increased costs to consumers, then that negates the plan to stem inflation and have economic stability. So is there something the Nigerian government can do to cushion the effect that these policies are said to be having on the manufacturing industry?
All right, I have a personal bias for the manufacturing industry, especially for the manufacturing industry and the agricultural sector. I believe that those are 2 key sectors that can jumpstart any economy. When you look at the history of developed countries, they started with agriculture and moved to manufacturing, and they are now technological giants, and they find themselves constituted as G7 and G20s and what more. So my bias for that sector is there. I also must say, without any form of bias also, that I think these policies are not particularly fair to the manufacturing sector. And I think they create 3 things that I hope that the CBN governor and the CBN is actually listening to right now. They create information asymmetry. And what does that mean? It means that some people, some manufacturers and some people in the system may have an upper hand in getting information and getting access to funds that will put others at the detriment in the same market. Secondly, they create a fallacy of composition. It begs the question of the economic logic that actually drives these policies. And what does the fallacy of composition mean? It means that when you're designing these policies and you're just having the financial market and the financial system as a pivot, forgetting that there are other systems and other sectors, the real sector, that actually drive the economy and create employment and guarantee the employment, full employment of all the factors of production, there is a problem. Lastly, if we do not deal with these policies before I come to what the central bank should do, it will continue to perpetuate the good/bad paradox. Now, what does that mean? These policies are actually good. But if there is a fallacy of composition, they seem to be good for a particular sector or some sectors to the detriment of the real sector, manufacturing and agriculture. Yeah. Finally, what should the central bank do? I think the central bank should isolate the manufacturing sector and the agri sector and follow the strategy of implementing what I call strategic quantitative easing, and use the commercial banks as agents to monitor what is disbursed to these firms to ensure that these loans are recovered from them. These loans can be single unit interest loans or they can be zero interest loans. This way, the manufacturing sector will perform, and we can systematically use quantitative easing, supporting manufacturing firms to fight inflation and make sure that there's price stability across the length and breadth of the country.
Well, it's always nice engaging you, Kenneth Ikenwa, business and social policy analyst. Thank you so much for sharing your insights with us. We appreciate that.
Always my pleasure.